In today's interest rate market, I want to focus on the 10-year note. The 10-year note realizing another nice rally today. We saw it up quite significantly, actually. A third day of upward pressure on the 10-year. We saw it pushing up to the 129 handle, 129.13, the current level. So again, we're seeing a rotation, it feels like, as we see the markets adjusting for some of the dynamics and some of the storylines within the market. Certainly when you look at the price action, I think it's being dictated to some degree by the Fed this week. Certainly we had Fed Chairman Powell testifying the last 2 days on Capitol Hill, indicating that they basically expect to stand pat on rates moving forward. And if you look at the CME Fed Watch tool, that's basically predicting that there's not going to be a move possibly until maybe the middle of next summer at the current price points within the bond market and the Fed funds rate. And also when you look at the other parts of the testimony, I think one key factor of why possibly saw some strength in the bond market today, once again, is the fact that he pointed to the fact that they're still not seeing inflation, even though he says the economic structure is in pretty good shape and they're not going to particularly move on rates in the short term. He did say that inflation still remains stubbornly low, basically, and that would be an indication that that gives them room to move if they feel like they have to, should we see economic conditions weaken in the next coming months. So I think that's part of the reason why we saw a nice bounce in the 10-year today. Couple that with the fact that we saw some weak data coming out of Europe as well and Asia, and I think that's another reason why we're seeing this rotation kind of taking place the last 3 days. Looking at yields, we're seeing that 10-year yield now pushing back down to, again, the middle of the range, maybe the higher end of the middle of the range, but nonetheless coming off those highs from just a week ago. We saw the 1.97 level, 1.812 right now. So we're seeing it pushing back down to about the 1.8 level, and which, if you look back over the last couple of months, it's interesting that we're breaking back below that peak that we saw in October and September. So I think that the fact that we're now pushing back down to this range, if we see a break of 1.70, that would definitely shift the momentum back to the downside right now. So I think that's the technical level I'm looking for. We're seeing, again, some pressure here on yields as we're seeing bonds being pushed higher, primarily due to the fact that we continue to see stagnation in the trade situation and the fact that global growth continues to stagnate as well.